You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome to the show, Danielle.
Hey, Jim.
Well, plunging oil prices have done more than just hurt the profits of the big oil companies. They could come back and bite the banks and a lot of other people pretty hard.
Yeah, well, because the hot area the past few years since the recovery began, the so-called recovery out of 2009, the main driver of that was certainly the energy sector. And they were both a benefactor of the credit bubble and overinvestment that took place, leading up to the peak in 2008, as well as the resurgence of free capital that came into assets and markets with the QE renditions that started. So lots of free-flowing capital was attracted to high growth, high beta areas like energy, very capital intensive businesses. They needed lots of funds, but they were able to borrow at record lows because interest rates were so low and because there was so many people chasing yield and they weren't paying attention to the risk. They were just, buying anything at all to look like they were making income. And so you had junk bonds in that space, and energy being a main area of that type of issuance, where they aren't A credit by any standard. They're B credit and less. Were issuing bonds, Jim, hand over fist, as if they were Government of Canada bonds. Like they were, issuing debt to investors and paying 5.7%. So that's really unprecedented. And what happened was, in the last 5 months, as the price of oil's, collapsed from 102 to 60, you've seen this evaporation of their cash flow, profit margins collapsing, and at the same time, Jim, their financing costs have nearly doubled. So today they're having to pay close to 10% interest when they try and raise money in capital markets, if they can find interest at all, because people have so gone off the sector. It's that hot-cold love affair that they were hot for a long time. Now that prices have been crashing, energy companies themselves, the equity prices had fallen 40% in 5 months, along lockstep with the price of oil. And so imagine the shock that they're in when they realize that profit margins have evaporated and they've borrowed tons and tons of money. So all of this, $500 billion in bonds issued in that space just in the last year is having to be serviced now. And so now they're having to literally, because they can't raise capital in the open markets and they haven't built up cash in their coffers, they have to do things like take money on their lines of credit or sell their assets to try and generate cash flow. So they're in full-on liquidation mode right now. So there you go. It shows you that when highly levered industries go into a cash flow crunch, their ability to ride that out is typically very short and it's measured in a matter of months. And within a few months they get into full-on panic mode. And that's really what we're seeing right now. So I think you're going to see probably significantly lower prices in many of these commodities, energy. The CRB, I put that chart on today on the CRB index being the basket of global commodities, Jim, has broken below the support that it enjoyed all the way from 2010 when they first began the QE. And it's quite obvious that every time they brought out a round of QE, for the reasons I've explained, you saw sort of a pop in prices in the commodity space, both in the actual commodities and in the companies themselves. But that always was short-lived, and it reversed as soon as the capital flows began to wane. And you see that happened again when they finally pulled back on QE. But now we're well below that line, and mean reversion seems to be the dominant hand in this struggle for control. And so you could see the CRB fall another 25% just to get us back to the lows of where the whole big boom began in 1999. And so that matters, because once it does that, and this is the point I think many people miss. I think many people are conditioned by the prior boom to think that when prices come down, they're a buy the dip and they'll just do a V right back up again shortly. They're always seeing it as when do we get in? When do we get in? What they miss is that at the end of a secular boom phase, when mean reversion takes prices back to the low of the whole phase before the whole thing got going, they tend to languish there for years. So it is a gradual grinding, sideways and getting rid of the excess capacity and inventory before scarcity is created once more, and then a new fresh boom can begin from there. But it's not a V-shaped recovery once it does come to the bottom.
What about all these companies that borrowed money to go and buy their own shares back at record high prices? What's going to happen there?
Well, that's the quickest way to evaporate capital. Again, they were doing a very similar thing. So it's not just the energy space that was doing this, Jim. It was the high-yield debt space in general. So many companies, even the investment grade, which, questionable whether many of these companies deserved investment grade status, but they were doing things like the Apples of the world were issuing long bonds at 1%, Jim. So lots of people issuing tons of debt just because everyone was gobbling it up, so to speak, without thinking, just following this idea that you had to buy something, so you buy anything, junk and all, right? So what happened was, again, we've been standing back from high yield debt since 2013 when we sold out of it because we know it follows the equity cycle. And we had a fantastic buying opportunity last in early 2009 when high yield debt had fallen 26%. Then you were able to buy it with yields north of 10 and, reasonable principal security. But when you have it mispriced so much as it has been in the past few years, it's just an accident waiting to happen. So again, you back off from that, you let the, bad debts finally shake out, and the default rate in this space could be, 20 to 40%. I mean, it could be extremely high. And once that risk gets priced back in, then you'll notice that, there'll be much better opportunity and much higher yields. But again, today you get this reflex rally in equity prices, but credit is not participating. So the corporate debt market continues to weaken. Bond prices continue to fall, yields continue to gap wider, and we're right around 5%. And in the past 18 years, every time that, the corporate debt spread over similar dated treasuries is 5%. Once it rebounds through 5%, it tends to mark a major market drop in terms of equities because it's a reversion phase where everyone starts to appreciate the risk they've taken on and starts wanting to get out, and weak players start to fail, and you have this cascade topple effect where everything kind of falls over. In our last client letter, we were talking about the fact that all this QE and belief in central bankers has built piers, not bridges, in the past few years. People thought it was a bridge to growth, that we'd get over a weak patch and that the economy would pick up and everything would go on its merry way. In fact, it hasn't happened, and the economy is weaker, and all over the world you're seeing that, and so people are left holding all this sketchy debt and realizing, what were we thinking? This is classic, even in individuals or families when they went through periods of rapid growth or, huge inflows of capital, they tend to adopt very reckless habits and, spend it really fast and not do intelligent things with it. And then when the cash flow reverses, they're left with these assets that they can't unload except for pennies on the dollar, and they're thinking, what were we thinking? And the point is, they weren't thinking. They'd stopped thinking long before that, and they'd been just doing foolish things. And, so we'll see how this, for example, the U.S. dollar is strengthening still today. It's through 88 now against the basket of world currencies. And our work suggests that may indeed be a secular shift. Again, Jim, in our work, this does not seem to be a blip or a short cyclical, downturn or where everything readjusts. We think it's probably the end of the secular boom for much of the debt bubble that took place, and that means that growth comes back down and commodity prices and asset prices, everything really comes back down and tries to re-equalize itself with the spending power available in the actual economy. And so when the U.S. dollar strengthens, it tends to be very difficult for other countries because most global trade is priced in U.S. dollars. Most foreign investors in the world, Jim, think of their options in terms of their home currency and the U.S. dollar. So when the U.S. dollar enters into a major uptrend, breaks out against all the other global currencies, it tends to suck capital out of the rest of the world back in other currencies and other economies back into U.S. Treasuries primarily. I know a lot of people have been saying, well, won't they go to U.S. equities? That's a small amount of capital has the mandate or interest to flow into equities, but the bulk of it is a play on the U.S. dollar. They want to be in the U.S. dollar for the appreciation factor that they anticipate, and they're very happy to hold treasuries rather than the risk of equities because the currency gain and the stability of price is what they're really looking for. So anyway, it's a fascinating time, and to watch, volatility come back into these markets. You got the Canadian markets had swings of 500 points a couple of times in the last week. Now we're starting to see volatility again. For a long time, people would talk about a 100-point day and think that was something, but then everyone's got a very short memory, so they forget what a real bear market movements look like.
Well, sure. Earlier this week, a 300-point plunge for the TSX.
Actually, that was a closing plunge, but I mean, we watch this all day long on various things that we track, and yeah, it's been down, close to 500 points twice, and then have some kind of late day rally. But there's so much nonsense going on. There's so much manipulation and algos and ridiculous price spikes at 3:30, and it is an absolute casino of the bizarre. It is the farthest thing from investment markets today, and the good news is that the way to leverage and reckless behavior always has a way of finally imploding on itself, and I think that this one's going to be epic, really. It's I've never, in my whole time of doing this work, I've never seen anything quite as contrived and, farcical as what we've seen in terms of the capital market flows in the world in the past couple of years. And so I really am thinking this is going to be an epic cleansing process.
We'll have more with Danielle Park right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600. 604-699-8600.
Welcome back. We're speaking with Danielle Park. Danielle, will the consumer really come out ahead with all these lower gasoline prices right now?
Oh, absolutely. I mean, again, from a consumer's perspective, deflation is a good thing. Deflation in prices means that even if they're not experiencing wage gains, which they have not, households have not in North America for the past 30 years experienced wage gains in real terms. So the best way, if you can't get wage gains quickly, which you can't in this environment because you have deflation in so many different aspects of the world and the weight of the debt, you're not getting a lot of traction on household income. So the best thing that you can do to help the households then is to bring prices back down. Now, this is the antithesis of what bankers want, because and those that are in debt like to have inflation because that makes the burden of servicing that debt lower year over year. But for people that actually have cash and are not heavily indebted, deflation is a fantastic thing. When it comes to the consumer, unfortunately, a lot of the consumers, Canadian consumers in particular, are the most indebted they've ever been. Bank of Canada issued a report yesterday saying, hey guys, this is not good. We're not prepared for a slowdown here by any stretch because people have such fragile balance sheets and so little savings parked away. But anyway, the point is that lower energy costs can help the consumer in this very stressful period for sure. So that's helpful. The problem is that the net improvement to their, it just means they have some more cash to put into groceries, for example, or, it's not like they're likely to go out and book trips with excessive or, buy more housing or, anything that people think will really drive an economy. They're just more likely to have a bit more dollars to put into the other essentials, frankly. And so, that's helpful. I'm encouraged by that. But it's the offsetting entry to that. So how growth in GDP is driven by, governments, business, and consumers, and then imports minus exports. But the other way around. But anyways, the point is that the consumer is able to spend on other necessities, but is not new, fresh net spending. And that benefit is offset by the cuts on the business side. So you get the capex of companies being slashed because they are feeling a cash crunch, because they are seeing revenues fall. There's a lot of feeder fish off of energy in North America, as an example. A lot of service and other businesses, not to mention government revenues, have all been enjoying benefits from an appreciating or higher energy costs. Now that those things are mean reverting, that all goes the other way. So you get a cash crunch in many different ways throughout the system. And the first thing companies do is they lay off where possible. And you're seeing that Canadian banks started missing their targets in the last couple of weeks and have announced some layoffs. That's part of it. The other thing is they put off or cancel or stall some of their capital expenditure programs. So money that they thought they would be spending on equipment and goods and expansion, they suddenly put on hold and say, geez, we're not going to do that because, our cash flow's gone offside here. And so that is more of a net drag on the economy than the benefit of cheaper oil or cheaper energy for the consumer.
Do companies forget that when they lay off all these employees, there's no one around to buy their product? It happens every recession. And yet they say, well, we have to control our bottom line. But what if they held on just a little longer? Would that make any difference?
I don't think it will in this case. And if you think about what I was explaining, that this is a secular downturn that needs to take place because consumption was at elevated levels on the consumer credit bubble and simply cannot continue there. And the mean reversion after these periods is, think about how long it takes to pay down debt. Jim. It's not something a person typically does in a matter of months. It takes years, right? And often you have to have a certain cleansing in the system in terms of bankruptcy because there's debt here that can't be repaid. So there's a bunch of stuff to do to get debt levels back down to reasonable amounts, and it isn't quick, and it's going to take quite some time, and so probably another 4 or 5 years before that process can be completed. And so for that reason, companies that think, well, this is a blip or this is a slowdown, like Canada, thinking, well, energy will be bouncing back in the new year any day now, and we don't have to cut our budgets, and we can go ahead with the tax breaks we've promised people in 2015. I think that they're going to find that's the wrong thinking, because this is not, in my view, likely to be a quick rebound, quick blip. This is going to be a consolidation phase where companies have to get taken out, the weak players. There's got to be just a pulling back in, a deflating of a lot of business models that got overdone in the bubble. So people are going to lose their jobs, and they're going to have to retrain and find new areas to make a living. And that is a very uncomfortable process, but it is essential in a capitalist society. It's how the system recalibrates and goes with the the actual factors of supply and demand again. So it's painful for the people that are losing their jobs, but it's essential. So any idea that you can prop it up or pretend and extend is not likely to be a smart move.
With oil revenues down so much, would the federal government rethink the $26 billion in tax cuts they've promised to buy your own vote?
Yeah, people have asked that before a few times in the last little bit, and we'll see what they do. Politicians are not known for their excellent business decisions, let's face it. I think there's no question, just as these companies are going through a cash crunch, okay, this is mirrored in the revenues of the country, in the tax incomes. This will be mirrored, the crash in income that's happened here. And so just as these companies are all of a sudden making cuts to everything they can in terms of expenses and in terms of, projects and things they have to put off and lay off, selling assets to raise more capital, all that has to sort of flow back down to the government level. And I absolutely think they're going to have to rethink their budget. I know they've been, dogmatically insisting that they are in charge of all this, but actually they aren't. It's a massive shift in the global economy.
Danielle, it's been great chatting with you.
Thank you.
And best of the season.
Yes, you too.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council, Incorporated. Her website is jugglingdynamite.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. You can also go to our YouTube channel, Talk Digital Network. You can forward comments to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.